My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour, Wes Gray, the alpha architect himself. So we're going to be talking about strategies, alpha, and what to do in this environment. Wes, for those who are not familiar with who you are and your background, just set the stage as far as what you've done, how you got involved in markets. What do you do now?
Yeah, sure. So I'll just give you the nickel tour. So I started off as a PhD in finance, University of Chicago. So I was always the original plan was be a professor and all that good stuff. Along the way, I ended up actually joining the Marines. Went to Iraq, came back, said, "Okay, I still want to be a finance professor." And then I got cold called by a billionaire in 2010. And then we got put in business with a 50 million seed in SMAs. And in 2012, we got an ETF business. And then we just been doing ETF SMAs ever since until about 3 years ago. And then now we're in the infrastructure business like yourself with Tidal, where we help people bring ETFs to market. So we kind of play on the asset management side and on the infrastructure side.
So the Fed has a bunch of PhDs too, and I think there's a lot of people. There's a lot of people that I think are skeptical of PhDs in terms of their ability to see the future. So I'm just curious, what was involved in you getting that PhD, and do you understand, having been in it, the skepticism around some of these kind of intellectuals at the Fed?
Oh yeah. So I mean, as you may or may not be aware, so basically when you're a PhD student, you're basically getting trained to be a professional academic researcher. So ideally, you actually, you're supposed to learn like the scientific method. Hey, we got competing hypotheses. Great. Let's go to the data, see who's the winner. And then, it's a continually evolving process. And you want to try to take emotion and politics and all that stuff out as much as possible. Obviously, we know that never happens. And PhDs are humans like everybody else. And, they always say, like, when you don't know anything, you actually don't suffer from too many behavioral biases. And then as you start to think a lot about something, you just get more and more overconfident. And so I, even though I am a PhD, I'm actually extremely skeptical of experts. And to your point, really anybody that's trying to predict anything about financial markets or macro and what have you, because just the evidence is not in their favor. There's no evidence that they can predict anything.
But you and I both know people like to gravitate towards people that have a certain number of letters after the name, right? I'm a CFA charter holder. You got the PhD. Why is it that despite all the overwhelming evidence that shows that nobody can predict the future, it's always the most credentialed that get the most attention? I always found that to be kind of interesting in terms of the media and in terms of acquiring clients.
Yeah, I mean, I think it just goes back to like behavioral psychology and this concept of what they call social proof. It's just, when people are operating in an environment where there's a lot of confusion, they're scared, they don't know what's going on, it just, for whatever reason, it buried in the lizard brain there. Hey, Joe Blow, my neighbor, hasn't been doing this. He's not a quote unquote expert. So why would I listen to his opinion? Well, this person over here spent 10 years of their life, hacking around on data and studying the subject. They must have a better opinion. And, maybe in a lot of other facets of life, that could be true, like, doctor, these sort of things, or maybe even like the service. Like, I'd much rather have like, gunnery sergeant who's been doing inventory for 15 years than, second lieutenant who tell me what to do. So sometimes experience and knowledge and expertise probably does matter. But in this very narrow, specific context of econ and predicting financial markets, it's just the evidence doesn't back that that's a good idea. But I think people still rely on the social proof component of it, just because they're afraid or they don't know themselves.
Yeah, they got to anchor on to something, and investing is right. It's always hard to really know how much of the outcome is in any industry is the result of effort, but you can make a clear link of effort to outcome when you're a doctor or when you're on the battlefield, even though there's obviously a lot of variables, right? Then in markets. Now that the social proof thing is kind of interesting to talk about for a moment, because that goes into a lot of what's happened in the last couple of years in terms of this tremendous rise of FinTwit influencers and TikTok gurus and all these people that were making these uh, memes on investing. Um,
Yeah.
I'm curious your thoughts on if you've seen anything historically like that, not just from the standpoint of looking at market history, but even from the standpoint of clients that you try to attract, right? Because I got to assume that there have been a bunch of these influencers that might come up to you and say, "Hey, listen, I got this great idea for a fund. It's just gonna be one
Yeah.
stock that I like."
So I got started in the internet bubble back in like 98, 99 time period. And so it wasn't the same, but they all kind of rhyme to your point. And so, yeah, there's certainly these periods where there's a lot of geniuses show up all of a sudden. And we have a lot of that. I mean, we like on our client base, like we're much more, our products are going to be bought, not sold. And it's, our mission as a firm is empower through education. So we don't really try to jam anything down anyone's throat. Like, you'll read our stuff, you like it, great. You can join the team. Otherwise, don't worry about it. So we kind of self-segment into an audience that is less prone to calling me up and saying, "Hey, Wes, like, you should do this Bitcoin thing with 100% of your money and it's amazing," or whatever the pitch is. We get that ever so often because over time we've just gotten more and more clients. And I definitely, there was actually just last year, we had a whole bunch, not a whole bunch, but for us, it was a lot. I'd probably say 5 to 10 people. They're like, this whole value thing, like, this is crazy. Growth, innovation's the future. And, I didn't know it at the time. It felt like a bad idea, but obviously the past year has proven that to definitively been a terrible idea. So at the very end of sentiment markets, even we see some clients that just, they think the world's changed and fundamentals don't matter or what have you. But for the most part, we got pretty disciplined clients just by the nature of how we interact with the marketplace from a marketing perspective.
I'm curious if you see that there's a signaling effect from people wanting to launch, some product that's really hot, right? So, I mean, the Bitcoin futures ETF is kind of a good example of that because a lot of momentum in Bitcoin, and then here comes ETF, and that pretty much is the top, right?
Yeah.
And it kind of makes sense because assets follow performance, right? So you
Yep.
want to launch something which is hot, but the problem is by the time you notice it's hot, it may already be near its end, right? So I want you to talk about that component because I think there's a lot of fanfare around new funds, but there's a lack of appreciation and understanding where the fund might be launching in a cycle of a theme.
Yeah. So the good news is there's an entire paper actually written by one of my old classmates, Zahib and David. I think it's called Competition in the ETF space or something like that, or Competition for Attention in the ETF space, where they systematically study, hey, when do product manufacturers launch products and what does that tell us about like the profile of those investments? And just as many people suspected, the kind of weirdo thematic, I want to call them like gimmicky funds, but we'll just call them gimmicky funds just for now. They always tend to get launched at the peak cycle of media attention on a different thematic and at peak performance. And of course, even though I don't know why people don't read these papers, people will launch these funds because, to your point, great past performance means that you could rally some troops and get some AUM, but it systematically on average leads to horrific performance. So if I'm a 20-year investor, investing in thematics or gimmicky funds is just empirically a horrific idea. But, I don't control investors out there and what they want to buy and sell, but it's a terrible evidence-based strategy, I would say.
Let's continue to go with that a little bit because over time, right, there ends up being new classifications and definitions which sound to me more like marketing terms than anything else, right? And I've had a lot of these spaces where it's a lot of people are skeptical of ESG, and a lot of people would argue that ESG is really just a marketing term and it's just chasing tech. All right. Educate the audience a little bit on why maybe they should be skeptical of some of these labels, especially at this point in the cycle.
Yeah, definitely. So going back just like the first principles in academic research, what kind of the geeks have shown is that in the end, you can boil down the performance of portfolios, and explain 90 to 95% of the movement in portfolio returns via like a handful of different factors, right? Like size, value, momentum, blah, blah, blah. And in the end, like when you buy a product, you buy an investment, you'd want to only pay for it if you thought it was actually unique or had a value add. And a lot of times what happens is when you buy a thematic, it sounds different, it sounds unique, it sounds innovative, but in the end, it boils down to this is just some factor. And a lot of times it's a factor that we know historically is really crappy. So, for example, the quote unquote value factor is a portfolio that goes long cheap stocks and short expensive stocks. And of course, over the long haul, buying things that are in the most expensive decile of the stock market is a horrific idea. Sure enough, guess what thematics end up basically doing? They systematically are betting against the evidence. And people don't know this because they're usually going to buy like the most expensive stocks in the market, which is just, it's crazy. So the problem is a lot of people they buy marketing, but they never really understand what is the process, and what factors or what exposures is that process delivering. And once they go through that analysis, which no one ever does because they like marketing, you quickly realize that, I would say 99% of stuff in the marketplace is not evergreen. It's just, a marketing pitch wrapped around, some story or narrative that, you could probably go buy that exposure cheaper, more efficient somewhere else.
Now it's challenging, right? Because you've got to be able to pitch strategies to advisors, asset allocators to get the assets, right? But they also have to then pitch that to some extent to their underlying clients who know nothing about markets. So I mean, part of I think the dilemma in the industry is that it's not necessarily the people in the industry that are falling for the narrative; it's the underlying clients that have nothing to do with the industry.
So, and that's actually a great point. And so now let's talk about reality, which is people who you're talking about, like Joe Blow and Susie, who they're slamming a hammer all day, and they have the advisor that invests their money, but the advisor has to deal with said person who's just subject to a lot of behavioral issues. A lot of times for them, you could actually argue that maybe a thematic is better than what they would do without that, right? They may go be a degenerate gambler on Robinhood, where maybe that advisor's like, man, like Susie's pretty crazy. Let me just buy this thematic fund. At least it's an ETF. It's tax efficient, relatively affordable, diversified portfolio, kinda. That's a lot better than her just going crazy gambling on weird stocks in her personal account. So there's also that element where sometimes an advisor intermediary operating on behalf of a maniac, maybe it's not the first best solution, but it's not a bad solution. And so that's where I think even things that may not look perfect on paper, in practicality, they might be a good lever, good tool for a certain situation, just because everyone's a little bit different.
Yeah, no, I mean that's a fair point. I mean, there's a lot of it's been made about target funds, for example, and that they're fairly expensive, and that you can just replicate it yourself. But if you're not going to actually have the discipline to do that, you're better off paying the fee.
Yeah, one, and probably better than anyone, because I've read all your papers on all like the tactical things. Like there's a million tactical models, and a lot of them work. You can go crazy. There's a lot of times there's economic reasons why they work, but then if you try to implement a model in practice, you quickly realize the psychology component, and everyone's like, well, why isn't it working today? And you're like, well, because it's a model, and it's not like a money minting tree. It's just you got to stick to the process, and that really is the hardest part of investing, is not really coming up with the best mousetrap. It's just getting people to stick to some mousetrap that's somewhat reasonable, and that's extraordinarily challenging. So
yeah, I'm kind of living that myself, with despite all the history I have on that using Slumber to Gold, right? I happened to launch it end of 2020. Not only do I not have the right kind of risk on environment last year because it's all about S&P, but then on top of that, I have a completely ass backwards risk off period because treasuries are not acting like they should, right? Until maybe the last week after.
100%. So I'll just give a simplified example, which is not like 100%, ground truth, but it help show the idea. So let's just say you had a fund that had one stock, Microsoft. You buy it at $1, it goes to 100, and now you're like, hey, I don't want Microsoft anymore. I want Procter and Gamble. And so normally, whether it's a managed account or what's referred to as SMA, whether it's a mutual fund, a hedge fund, whatever, how would you affect that transaction? Well, I'd sell the $100 of Microsoft. I'd have a $99 capital gain, and then I'd turn around, take the $100 and buy Procter and Gamble. Fine. And if you did that in an ETF, you'd have the same problem. But as you know, that's not what an ETF is going to do. What an ETF is going to do is say, we have $100 of Microsoft with a $1 basis. I ain't selling that. That would be crazy because then I got to, pay the tax. I am going to create a custom redemption portfolio. And so what I do is I create this custom basket that consists of $100 of the Microsoft shares. And then simultaneous to that, I'd create, just for simplification, a $100 cash basket. So the fund's not losing any value. And what would happen is the $100 of Microsoft shares would get pushed out to a broker dealer, and then the broker dealer would push in $100 of cash. Those are both non-taxable in-kind transactions. So then the fund got rid of Microsoft. Now it has $100 and it buys Procter & Gamble and reestablishes the basis at 100. So it's basically cheating. Is probably the easiest way to say it. But hey, your job as an American is to find how to minimize your taxes as much as possible legally, and that's just how the game is played and the rules for ETFs. I mean, it's like an unfair advantage relative to like mutual funds, but
absolutely,
from a public policy standpoint, it's actually way better because now, like, what happens is like if you're in a mutual fund and some big investor decides to blow out, you could get stuck as a bag holder with huge capital gains that you didn't even really cost. Like, so it creates like a negative externality problem. And so the ETF is actually the ideal standpoint, in my opinion, from public policy, because then it pushes out the tax decision to the client, right? Like you don't want the other holders to get screwed on tax just because someone's got a particular situation. That's just unfair. So
absolutely,
yeah, I think it's so. I think it would actually be bad policy to basically change the rules and then reimpose negative externalities. It's like saying, hey, the polluter, he gets to pollute the river and dump all his oil and gas into the stream and not pay any tax on it. Like That's basically, you're just like, why would you want to have a policy that allows that? That's crazy. But if you really think about it, it's only hurting the people that don't got the means to get rid of tax problems. Like, we deal with a bunch of ultra high net worth folks, and guess what? They have a million tricks on to create tax deferral. But how many tricks does like Joe Blow retail normal, hammer thrower guy out there have? None, right? The ETF is just like, if you took that away, now you're just making it more unfair. Like, I just think it's crazy from a public policy standpoint. But hey, I'm not in charge of the government, and I can't even vote anymore. I live in Puerto Rico, so I don't have any say. I don't pay into the system. But hey, I also can't. I don't get a vote anymore in federal elections, and I'm cool with that. So general. So it's really important to define what you're talking about, which is a problem I have, because if you're with academics, you're practitioners, everyone has the same word for different meanings. So in the context of how I define value, it's systematic value. And what does that generally mean? That means you're systematically going to buy cheap stocks on some price to fundamental ratio, right? Like whatever, PE ratio, book to market. We use enterprise multiples, but let's just stick to PE just to keep this simple, because everyone knows what a price earnings multiple is. And so how would you go about creating a value fund, and why would you want to do that in the first place? Well, why do people like value? The reason they like it, at least from a systematic value perspective, is that historically, almost regardless of what kind of value measure you pick, if you just systematically buy, say, the 10% cheapest stocks in the market and rebalance it once a year, like pretty brain dead process, we know over the long haul, you earn this excess premium. And there's a lot of arguments, for and against why that happens, but it just is. And that's why people want to invest in value, because you tend to, over long periods of time, when you systematically buy cheap stocks, outperform. Now, it's really important to highlight that doesn't mean you outperform every year, every 3 years, every 5 years, even every 10 years. That means over like 20-year horizons, you probably got like a 90, 95% chance. But in any shorter window than that, it's anybody's guess, right? So that's the basic concept of what people do and why they want to do it. And then so that's all fine and dandy. And then so what you want to do then is when you look at buying a systematic value fund, we all know from the research that, well, how does that work? Well, you got to buy cheap stocks. And so one of the easiest ways to assess, is my value fund actually have a chance of capturing the so-called value premium? Well, just go look at the average PE ratio of the holdings. And a simple example here is go look at VTV. I don't have the number off the top of my head, but VTV's price to earnings ratio is damn near similar to the S&P 500, right? It might be a little bit lower, but that's not the value factor. That means you're kind of maybe tilting a little bit away from all the normal stocks and putting a little bit more weight on the kind of cheaper stocks. But that doesn't count. Like if you want to get value premium, you need to actually buy cheap stocks. Duh, right? And so what we do in our process, and not a lot of people do this because of what I mentioned up front, like this is a long-term thing. It doesn't track the index every single day, is we start off, well, there's a bunch of things up front, but basically we're getting to the 10% cheapest securities in the market. And again, we use this thing called, it's basically operating income to enterprise value. But just think of it as like, if you're a business owner, what does this business earn? Well, I got the revenue, I got to minus off the cost of goods sold, and then I got to minus off the SG&A. What do I got to pay all these people to run this thing? That you're left with essentially your operating income. Like, what does the business make? That's also referred to as EBIT. And then you just got to figure out, well, what do I got to pay for all this business? That's called enterprise value. We use that ratio, but it's kind of like a PE ratio. But the key part of our process, which is critical, is we focus on the top decile, i.e. the cheap stocks. And what is the outcome of a process that does that? Well, right now, the PE ratio on QVal is like 7, right? And the S&P is like 25 or something crazy. At VTV, I don't have it off the top of my head, like the most recent, but I'm guessing it's around 20, right? So just logically, if you're, and it's not saying you'd have to buy our fund in particular, but for any fund, if you wanted to capture value, just a very simple way to assess if it's actually going to capture the value premium is, what is the PE ratio of all the holdings on average? And it should be really cheap. Otherwise, you're not really buying a value fund. You're just buying a marketing ploy, or you're buying, what they call like a closet index, like someone who's pretending like they're doing something different, but really all they're doing is just buying the S&P with some noise around it.
But Wes, as you alluded to, the key thing is you got to stick to the fund and the strategy, right? So it's been, and you can correct me if I'm wrong on this, but it's been my experience and from the research I've seen that you tend to have stickier money in mutual funds versus ETFs. And I say that purely because it has to do with the frequency of pricing, right? Mutual fund prices once a day, ETF second by second, which means that there's a temptation, right, to trade. So talk about that aspect of ETFs, because I think that's also not really appreciated, that even though ETFs are phenomenal as a vehicle, it creates a certain degree of maybe poor investor behavior.
So this is something Jack Bogle, rest in peace, obviously, like founder of Vanguard, used to always say, where he hated ETFs. He understood the tax benefits, all the other things. He's like, no, this is going to be terrible, because he was talking to exactly what you're mentioning, which is the investor psychology. And so an ETF, what's the best way to explain it? I can't think of an analogy here, but it is the ideal wrapper for long-term investment in equities and a lot of other things, under the assumption you buy and hold the structure. But if you turn around and day trade an ETF, like all the tax benefits gone, all the benefits of not incurring frictional costs every time you buy and sell gone. Like you're just a degenerate day trading gambler again. And the ETF is not going to protect you, right? It's just it won't. You're kind of kicking yourself or shooting yourself in the foot, I guess, if you engage in bad behavior, really in any context. And frankly, that's why, I mean, you guys probably heard this argument, but and we see this all the time with, like, we have a bunch of like people that we work with that are super rich, and I would say probably 90% of them are real estate investors. And the reason real estate investors make so much money is because they hate paying taxes, right? So they sell a building, but they'll 1031 into another one. And the other thing is the real estate market's not super liquid and it has super high transaction costs. So you're super disincentivized to not trade all the time, which means a lot of times you're just forced to hold on to something, even though you may want to jump off a bridge. But that's how they get rich, right? They avoid taxes through the 1031 exchange, which is just basically equivalent to what ETFs do with stocks. Except the difference is real estate investors, it's not easy to transact. So they're forced to buy and hold. And if you're forced to buy and hold something that's tax deferred and captures risk premia over a long period of time, the math works. You'll get rich. But the problem with ETFs, to your point, is that you're not forced to buy and hold. It's very easy and low frictional to just like, oh, let's go sell it in my Schwab account, and all you're doing again is just shooting yourself in the foot. 9 times out of 10.
I want to keep going with this mutual fund ETF discussion for a moment here because
sure,
there's an unfair advantage you can argue with ETFs versus mutual funds because of the tax benefit. There's also an unfair advantage that mutual funds have in the sense that you can pretty much track the fund flows with a mutual fund, right? Meaning you can have salespeople, you can incentivize them to try to get assets and then pay them basis points based on that data. You don't have that with ETFs. You don't have that degree of flexibility. And I'll tell you, I've always felt that that's one reason ETFs will never fully replace mutual funds as a structure because one has a sales team that can be paid for their efforts and one really doesn't. Right? So let's talk about that for a moment to the audience because I think that it kind of makes the discussion around this idea that ETFs become the world a little more nuanced.
So 100%. And so one live example of that is one of my teammates, Ryan Carlin. He has a great story where he used to work at a firm called Revenue Shares, right? Where they're an ETF company. They got bought by, I don't even remember, Oppenheimer or something like this. But they charge 50 basis points roughly on their funds, right? And then they went to a mutual fund. They got bought out by a big mutual fund company where the products were an average, 1.5%. And they got bought, and they're trying to tell all the salespeople, hey, you guys make 50 basis points selling mutual funds. We have these really new, cool ETFs. They cost 50 bips, but we're going to pay you 5 bips to sell these. And so immediately you got an issue, right? Because the problem with ETFs in general is they're hard to distribute. One, because of the transparency on the transfer agent file, you can't actually identify who's buying and selling a thing, but they're also just too cheap. Like, so how the heck do you ever incentivize someone to go sell it? And I actually think that there's a good and a bad thing, right? So for super unique, boutique-y, rare strategies, you might just need a sales force, but they also have the capacity for payment where maybe you could facilitate that. But I think the way the world's going, and actually being on Twitter here is a good example, and like all your Twitter followers is a good example. In our experience, I feel like the market is moving away from foot soldier armies of expensive wholesalers trying to kick in doors every day because there's just not enough fee and not enough transparency to go around to make that work. Where it's really kind of going to scalable thought leadership marketing where I could see an 18-year-old kid with 5 million followers on TikTok and a religious, hardcore audience. That person could be a great ETF sponsor, right? Because they can get rid of a lot of the heavy cost on distribution And I just see there's a lot of models out there through software, through social media, through all kinds of mechanisms where the old model of selling will always be there in some form. Products don't just, sell themselves, but I do feel like it'll just get more efficient. People leverage technology and, personal brands a lot more to distribute because less so about the transparency on the fact that mutual funds, you can know exactly who's buying and selling, so it's very easy to compensate, but more related to just competition on fees, right? Like, I mean, there's not a lot of meat on the bone if you're selling a 50 basis point ETF versus a 2% mutual fund. Regardless of transparency, there's just not enough economics to, compensate a hardworking sales force, essentially.
Yeah, no, that's a fair point.
Yeah, so I have this blog post I wrote about 10 years ago that says turn off your chief economist. And why that is a blog post and it references some academic papers is thinking about all this stuff is super interesting and tons of brain damage, but I don't know how to map it to investment outcomes that are predictable. So I don't frankly spend a lot of time thinking about these things because they're interesting, but I don't know how even knowing a lot of the knowledge out there, if you could predict stock prices, right? Like if you told me a lot of macro data, or even if you told me what the Fed's going to do, and no one in the market knew, like it's unclear to me you could actually even make money because it's really hard to understand what is the current expectation that's embedded in the thing already. So that's a long-winded way of saying I don't know. It's not something I focus on, but maybe there's other people out there who could use that to, better their investment decisions. But that's not my capability, unfortunately.
But let's tie that a little bit into ETFs, because there's a mindset out there that there's a lot more fragility and that speed is faster than ever before because people can trade the whole market in a single click with an ETF, right?
Yeah.
Do you find that the ETF structure maybe could present some problems to the way market volatility historically has behaved? Let's talk about that for a moment.
Yeah, so I actually it's actually on my shit list of blog posts to do. Like it's an internal research report we did. So we actually went back because there's this hypothesis out there that the markets are way crazier than they used to be. Volatility is insane. And so we actually spliced together a data set since 1885 with daily domestic U.S. stock return, or basic daily returns on U.S. markets. There's like 5 or 6 databases you can cobble together. And I just did like, hey, is this actually true? Is recent, like last 10, 20 years, or daily stock movements, more crazy than they were in the past? Answer, no. So just empirically, it's almost, I feel like it's a recency bias, right? Like there's a base rate of craziness if you look at enough data where the current environment juxtaposed against that, there's no evidence that it's like extreme. But whatever. So that's just empirically what the situation is. But that doesn't mean that prospectively, because to your point, like ETFs are taking a lot of assets, like passive seems to be eating everything on the planet Earth. It seems to be like a flows driven market, not fundamentals based market. And I'm super open and amiable to all of these because we all live this every single day. Again, this is a thing I just don't know, and I don't think anybody knows. Right? This is something that's actively being researched by a bunch of academic researchers who are trying to understand it, and they're really at kind of the early stages of this. And there are some papers out there we've talked about on our blog where it seems to suggest that ETFs and kind of like financialization of individual securities now in portfolios has maybe at the margin increased volatility in the underlying holdings, but it's 51-49 type evidence. It's not 99-1 slam dunk type stuff. So I frankly just don't know, but it's certainly something that pay attention to, and want to listen to the academic researchers who are trying to figure this out as best they can.
Let's go back to the point you made earlier about factors, right? That it's really all just a different factor. I've always made this argument that factors have cycles. Factors also have momentum.
Yeah.
There are certain
Yeah.
environments where certain factors are better than others. I'm
Yeah.
curious in terms of how you look at the current environment.
Yeah.
What kind of factors should people be thinking about? Because obviously momentum's not there, right? So what else other
Yeah.
than value, momentum? What else do you think is interesting to pay attention to here?
Well, so this is something we've thought a lot about, done tons of research on, just the broad category of how do we predictably and reliably build a system to time factors? Like, how do you factor time, right? And there's tons of theories, tons of research, tons of papers on different schemes to try to do this. But what you find, and you know from doing your own research, is when you look at enough samples, enough geographies, and you get the full data set, that's when you can really start to make a collective kind of meta decision on, well, what actually works, what's bullshit, what's cherry picked, etc. And so my conclusion from literally reading every paper on this collectively and doing our own research is the only thing that I know of that has any semblance of being like a positive predictability bet, but the caveat it's noisy as hell, is relative strength. Like good old fashioned momentum, right? So what you do is you take whatever factor portfolios you like you feel that are like, different, like so value, momentum, quality, size, beta, whatever the heck is in your set there. Let's say you get 10 of them. And if you wanted to engage in a factor timing exercise, the simplest model that I know that actually has evidence behind it over long periods of time, different samples, is just momentum, unfortunately. So like just what's factors winning over the last 12 months, you want to focus on those and you want to focus less on those that are in the dirt bin. That's the only thing I know that is evidence-based. Like people have like, well, interest rates do this. Well, this does that. And there's one paper will say, well, yeah, interest rates time value. And then other papers will say, well, we got more data out of sample. And how do you do that? Not really. It's kind of noise. So there's always narratives and stories out there. And there's always one paper that will say, yes, that's a great idea. But the problem is there's 5 other papers that say it's more mixed. So again, it's relative strength. If you wanted to engage in factor timing, which we don't, because I think after frictional costs, taxes, and brain damage, it's still not worth it. So we're more of like strategic factor buyers, but that's okay. You don't have, other people are different. If you were going to do it, or if I had to buy a fund that did factor timing, I would make sure that it had some sort of momentum component as like a core aspect of it.
Yeah, no, I think that's fair, and kind of reminds me of a lot of those studies that show that if you were to actually test any kind of study in the past, you'll see that there's probably not as strong of a conclusion as you would expect, right? And that goes beyond just investment field, right? That's sort of in general with the sciences. I'm curious, Wes, what are you seeing in terms of where people are trying to allocate, or where they're finding where you're finding people have the most interest, right? Because this year has been notoriously difficult for diversification unless you held commodities, right, for the most part. But talk about on the ground, what are you hearing from advisors and allocators in this kind of environment as far as where to put money to work?
Yeah, so I mean, unfortunately, all the things we do have last 10 years been dog turds, right? So, hey, you should buy value stocks, you should buy momentum stocks, you should trend follow. That was like total doghouse. And now everybody, that's all they say, right? They're like, hey, we should trend follow, we should do value. And I'm like, well, no shit, but you should have done that like historically, not after the fact, after it's already worked. But that's another discussion. So the main things we're hearing is, value. We got to get in the value trade. Like now that it's had some good performance relatively, it makes more sense. That's totally illogical, but that's a big thing. And then the other one, which I'm sure you're aware of, is just fixed income, right? Like the fixed income sucks. Like, why am I buying this tax inefficient thing that has a lot of tail risk? Like I need a better solution. And of course, just because, if you got a hammer and you see nails, you hit the nails with a hammer. trend following. So like, hey, you like, take some commodities, take some bonds, take some gold. Doesn't even have to be complicated, and just trend follow that basket of assets. It's probably going to do all right, right? You're going to be long commodities. You're going to be flat to short bonds this year. And those systems work, in my opinion, and they don't even have to be complicated. You just got to stick to them. And so we're recommending and telling folks like, hey, focus on either DIY that or buy tactical products that do this and use them as a replacement for just static buy and hold fixed income portfolios. And that doesn't mean you can't own fixed income, but don't own it as like buy and hold. Own it if it's in a trend. Like otherwise, just either own short duration cash or own things that are trending. But this is something we've been saying forever. It's just 60-40 buy and hold US centric has been a hedge fund the past 30 years with a 2 sharp. And it's really hard to tell people to do something different unless the whole thing blows up, which obviously this year that's what's happened. So now these ideas are obviously getting more traction and people are more amiable to deploying them in their portfolios. So on the first question, this is one of those things where the devil's in the details, and the question I think is related to, and I'll just simplify this. Okay, you have value stocks, you have momentum stocks. We could do a strategy that says, well, hey, let's go buy the cheapest stocks and let's go buy the cheapest or the best momentum stocks. We'll 50-50 them. That's one idea, right? I guess you call it like siloing. The other idea is you can say, well, that might be inefficient because some of these value stocks might actually be really low momentum stocks and so on and so forth. So let's just do an integrated approach where let's just look at the stocks that have the best value and momentum characteristics and kind of do it like integrated in a portfolio. So that's kind of the genesis, I think, of the question. And then what I would say is there is no right answer. Again, devil's in the details, but they end up netting out, in my opinion, to basically being 6 of one, half a dozen the other. I think in the specific context of concentrated portfolios, where you already have like negative screens on the other factor, like for example, you have a value system that negatively screens like horrific momentum stocks, and they're concentrated portfolios. I actually think at the margin, there's evidence that siloing is actually better. And there's also better diversification benefits, but whatever. Let's just assume they're even, right? Because that's the easiest assumption here. And I'm biased because that's just how I like to do it. But I probably got an issue. I also prefer the siloed approach just from a straight up investor psychology transparency perspective, where the issue is if I have a pure momentum thing and I have a pure value thing, and everyone kind of has a vague idea of how these things are supposed to perform, how they're supposed to act, it's very easy to explain to people, hey, my value fund is like a big turd, until this year. And they're like, oh, well, that makes sense because it's a value fund and all value funds are big turds. Whereas same thing in momentum, right? Whereas when you have an integrated portfolio, if you have a PhD at the helm, like fine, they could probably attribution it after the fact, but it's very difficult from a like investor psychology standpoint to explain why this fund is doing what it's doing without getting way in the weeds. And it's bad for investor behavior, in my opinion. So at the margin, I personally prefer siloed things, even if you assume empirically they're the same, or even maybe they'd be a little bit less, just because you get the benefit of the transparency on ex post understanding of what the hell's going on. But overall, empirically, I think they're about the same. And I think at the margin, when you're doing concentrated, it's better to silo. That was question one. Question two, we get this asked all the time. And unfortunately, you just legally, it's impossible. So we looked into this, and the rules related to like the EU and the UK and what have you, some of the rules are actually against SEC regulations. So if we were to actually do some of the disclosures and some of the requirements that you would need to be able to get the things qualified over there, you would literally be in violation of SEC, which is the US regulatory body. So the way people get around that is they literally set up another company. So you'll notice like BlackRock USA does not deliver European products. BlackRock Ireland does, right? Or Vanguard Ireland does, because they have to literally set up an entire new business that falls under that country or that region's regulatory regimes. And we're not BlackRock, unfortunately, so we don't have the resources or time to literally set up another company in Europe. I wish we did, but that would be the solution. And so it's just unfortunate, and it's probably, I imagine, for indirectly, it's anti-competitive measures on behalf of like different countries where they kind of want like the big scale economic monopoly players to kind of push out like kind of like the mid boutiques like us, because they know we can't compete. Even though I'd love to go in there and compete and like rip cost out, make it more affordable, all that good stuff. We're not, we don't have the scale or capacity to do it. And I'm sure that's not, yeah, I'm sure that's for a reason, right? Like a lot of big players, they don't like competition. So you find ways through government interventions and regulatory edifices to make sure the competition doesn't show up. And I imagine there's some element of truth to that, and why we basically can't enter those markets easily, unfortunately.
I want to go back to the name of the space real quick, which is finding alpha when there is none. How do people navigate this environment when the environment doesn't really seem like it's ever happened before? I mean, a lot of people will make comparisons to the 70s, the 40s, and everyone's trying to look for some kind of fund that can maybe do well in this environment, but it's hard to really know what factor can work when we're in a really odd environment. So talk about that for a bit, because that's the $1 million question.
Yeah, I mean, so I always tell people focus on things you can control, which would be your fees. And that doesn't mean just buy the cheapest piece of junk you can find. It means that be very focused on, like, if you want to buy something that costs money, make sure there's not alternatives out there that can be done cheaper, more efficient, et cetera. Because at least you can control that. And then obviously the other one is just taxes. At least in the States, that's anywhere from 20 to 50% carried interest fee, and you probably want to focus on that, because if you don't get your fees and taxes controlled, it doesn't matter how good your investment is, it's kind of a waste of time. So those are the two things that I think people should spend the most time on, at least initially. And then as far as like the actual investment approach, and I don't know if maybe I'm just old or just busted, but I just believe in fundamentals in the end, like cash flow. And if you have horizon and you can find assets that have high cash flows and you don't have to pay a lot for them, and they seem like they could reliably hang out for a while, like that should matter. Like that, it may not matter from a mark to market basis, because all the like go-go stocks that make no money and sell Ponzi schemes may have a better mark to market valuation. But I'm a believer in the weighing machine, like Ben Graham's, like I said, maybe I'm outdated that, cash is king and fundamentals matter, but I think they still do. You just got to have the horizon to see it out. So I think that's where I'd focus on. You want, and when you're not focused on that, because that's like the value investing component. I'm also obviously a fan of like human psychology and like technicals, but and so on part of your book, I would run it value, old school, like just what have you done for me lately? Where's the cash? And then I do believe you can exploit human behavior and trend following, and tactical also is a good idea. But there you just use momentum, and you got to make sure that you stay disciplined to the model, and you don't buy ARK, right? Like ARK has horrific trend. Why would you buy that, right? So if you're going to do momentum technical trades, you got to actually stick to whatever process or model you're going to do, or you're not going to get any alpha from that approach. And I see people that are quote unquote technical, human behavior exploitation momentum traders, and they'll love ARK on the way up because it's got high momentum. Now it's down, 70% and has the worst momentum ever. And they're like, oh, I got to buy it. I'm like, no, that's not technical momentum trading, dude. That's the opposite. That's called being stupid. So those are some basic principles. Just buy cheap assets that are high quality, stick to that discipline. And if you can do momentum technicals, just make sure you follow the actual rules that you set forth in the first place.
Right. At least don't have the negative alpha from not being disciplined and selling at the wrong time. Right. Is really, I think.
Yes. All these things work. And the alpha that people have is your discipline. Period. Like, lower your fees if you can, lower your taxes if you can, and go beat yourself up and like haze whatever it is to make, like, go listen to David Goggins and Jocko videos all day. Just stay disciplined to whatever process that you believe in, and just stick to it. That's your alpha. I mean, it's really that simple. In theory, as everyone says, investing is simple but not easy, and that's a very true statement, I would say. So we don't trade in that market. I have a bunch of PhD buddies that do that, like a group out of AQR and etc. That's pretty much a I think, so depending on if the data is any good, it seems to be the case that value, well, insider trading is always good. There's a lot of that there, but obviously you probably shouldn't be doing that, but people do. But I think value is okay, like value quality. And in momentum, it seems to work, but it's like longer term momentum just because the volatility of that market's so much crazier. It's kind of like Bitcoin. Like, you're not gonna do a 12-month trend following on Bitcoin. Doesn't make sense. Like, so maybe you shorten it to like 3 to 6 months. So that's what I've heard from people. Like, hey, value momentum still work. Momentum in particular, you want to shorten down the window just to have tighter like momentum look backs. And then on value, it's book to market sucks, but we already knew that. It sucks everywhere in my opinion. But things like dividend based value measures, or like earnings based, where there's actually quality backing them, just because you got to deal with the fact that you don't know if the data is real. That's at least third party from quant buddies, just from BSing with them a little bit. But I've personally not actively involved there. But I'm sure it's a great market for quant systematic, just because there's like big gambling culture in that area of the world. So, and that obviously means there's probably not a lot of hyper rational Cliff Azises walking around, which is great for systematics, right? Like if you have a system and it makes sense, you can probably take advantage of degenerate gamblers and make some money. But I'm not an expert in that market in particular.
Yeah, that's I think a good way to end it. So again, everybody that's here, I appreciate those that join. Please make sure you follow Wes. Wes, I appreciate you spending the hour. I'll make this an edited YouTube video on my Lead Lag Report channel. And everybody enjoy the rest of your day. Thank you, Wes.
Yeah, appreciate it. Talk to everyone. See ya.
All right, cheers.